Kangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the COB. One more day of reporting season. I'm sure everyone in markets is exhausted as we all are trying to pour through all these reports, but at least we had a positive session on the local market today. Let's see where we've ended up. Third of 1% there on the CBO 200. The ASX 200 at the close of trade is up by 0.25%, 8,261 points. Eagers Automotive and Medibank, who we spoke to earlier, doing very well today. So that is an encouraging sign, and certainly seeing a little bit of a lift from some of these big players, the likes of Qantas and Coles, which is reported a good number, and Qantas of course bringing back its dividend. Let's get though then to our themes of the day, because we've been trying to come up with a lot of puns for the selling that we've seen, but finally we've got higher at last. And then reporting raw as well. We mentioned there are a lot of those companies that did come through that have done very well. Medibank Private lifting its interim dividend. We also saw Neuron Pharmaceuticals rally on its full year sales. Coles, we mentioned, also doing well after its numbers. It hiked its interim dividend to 37 cents and also said sales and earnings had been boosted by the strike, the industrial action, remember, that hit its rival Woolworths in December. Having a look at bull in a China market though, because I spoke to Morningstar earlier and they're getting quite positive on the overall picture in China, reminding us that of course it is not necessarily in conjunction with what you're seeing in the overall economy in terms of the fact that China is still under some pressure, but you've got this deep seek as well. And I'm just trying to find a Nomura note, which is why I'm looking down, but it's chipped off my screen, so never wrong for long. I'll bring you the details later. But the analysts at Nomura have actually upgraded China stocks. So that's why we've got bull in a China market there, because there's a lot more positivity coming through in terms of what analysts are saying about the outlook for China. All right, let's go through some of these sectoral moves. Wesfarmers, we mentioned the retailers, the consumer stocks doing well. JB Hi-Fi up by about 0.8%. Levisa's up 1.5%. The miners as well had a pretty good session. Just having a quick look at where they are tracking. The Rio share is up by 1% and Fortescue Metals Group is up by about 1.1%. And a quick look as well in terms of what we've been seeing with the tech players, which are coming under some pressure, of course, continuing to focus very much closely on what's been happening at WiseTech and the fallout over Richard White, although he has returned as executive chair. And then you've got Zip coming under some pressure as well. Now, I found this note that I was looking for. Nomura maintaining its neutral stance on Chinese equities. The computer doesn't like me today. I found it and then it went away and now I'm back on screen. So let's just get back into some of the corporate stories. Qantas to pay shareholders a 16.5 cent per share, fully franked, and a special dividend of 9.9 cents per share as it talks up its balance sheet strength and ongoing investment in its fleet. Coles up about 3%, increasing its dividend. Ramsay Health doing very well, up 8%, exploring options to offload the majority stake in its European hospitals business. And Medibank Private up by 11%, expecting gross profit to continue in the second half of full year 25, while Perpetual shares were lower today after its numbers. Let's welcome to the COB Jimmy Jang from Macro. Good to see you, Jimmy. A lot going on. I'm still trying to find this Nomura note, but tell me what you've seen so far in terms of market action, and it's good to see a positive day.
Absolutely, yeah. So look, we have a great day today, but one of the key data that we kind of focused on internally was the Australia's private capital expenditure that obviously declined by 0.2% in the fourth quarter of 24. Obviously, despite the stronger economic growth prospects for the year. Look, it's largely probably because lingering concerns over interest rates and obviously cost pressures and even the global uncertainties a lot more apparent in the US right now. But the expectation is that we might see further acceleration in the fourth quarter for the national accounts, which means that while business investments lagging, the other parts of the economy, such as the household spending and also the public investment, might be offsetting some of these kind of weaknesses. But we saw some fantastic companies reporting today as well, just to kind of share some view. Qantas, as you said, Juliet reported some impressive numbers. Their adjusted pre-tax profit was around $1.385 billion, and also that pre-tax profit of $1.32 billion as well. the net income came in around $923 million, which kind of translates to about the earnings per share of close to 60 cents, which is fantastic. And like you said, the airline rewarded the shareholders with fully franked interim dividend of 16.5 cents per share, along with another special dividend of 9.9 cents per share as well. While this is all great, but some of the small concern that we found in the report was their financial health. So the group reported a net debt of $4.1 billion, which is somewhat that's a sizable number. But what we also kind of saw further in the report that the company is strategically investing in its fleet and is also targeting a $400 million transformation program in the financial 25 to offset these kind of inflationary pressures. So that was really kind of good to note in the report, which is great. And another thing that we saw in the calls, they obviously hit the all-time high, which is fantastic because we had calls in our portfolio as well. Their shares obviously reported the net profit after tax of close to $576 million. Which was largely in line with the market consensus. But what really stood out in the report was their supermarkets division. So their sales rose 4.3%, outpacing the Woolies 2.7% growth. The comparable supermarket sales also grew to about 3.4%, beating the market. So, and they also largely in somewhat benefited from that strike at the Woolies warehouses as well, which added another incremental 120 Australian dollars in sales. So that was really good, and also some leadership change, which was very smooth in our view. So really good day for the market.
Yeah, and it's interesting when you talk about Qantas there and certainly returning its dividend, but you're recommending that investors look at Air New Zealand. Why is that?
Yeah, really good point. The largely we align with the Australian market, but what we're seeing in the short to mid term, we might actually see the New Zealand as a whole might be a good market to get in now. And obviously with the rate cuts that's happening in New Zealand is a lot more faster than the domestic market. And with this rate cut, what we might actually see overall in terms of the sector, we might see that the tourism sector booming, obviously with the New Zealand dollar getting weaker for the market. And if you also look at their reports as well, the half-year earnings beat the expectation to about 155 New Zealand dollars million, and which is their pre-tax income, which also beat the market forecast. So New Zealand airline is probably in the really good line because they're also above the majority of the technical analysis as well. So really good kind of position to take advantage at the moment.
And what about West African Resources? What are you liking about that company?
Yeah, look, the uncertainties right now over in the US is really kind of frightening a lot of even our own investors as well. And we kind of saw a lot of other new trade policies kind of getting developed over in America, and also what's going to happen in Ukraine is another concern. So this kind of hedge against the market volatility is what we want to actually slowly allocate. The West African Resources focus on the largely mining operations, but in particular the gold production. They have two large projects called Sanbrado and Kiaska projects in Australia. And their production guidance is very solid. So their production guidance came at around 290 to 360 ounces of gold. And the Kiaka project is also on track for their first gold pour in the third quarter of this year, with another 10-year production plan coming in the late quarter 2 2025 as well, which we see is going to be a really positive outlook. So we just want to kind of get that in early before their 10-year production plan comes out. And it's probably good to kind of have in your portfolio now if you don't already have gold in your portfolio.
All right, well, you're talking about gold, obviously good to have in terms of times of volatility, which seems to be all the time now. But if we do see this potential trade war escalate, what should investors be looking out for?
I think the main thing is kind of identifying, whether your companies have any exposure to that kind of tariff risk. So, for example, for a lot of investors that has largely in the tech companies may not be as affected to that kind of trade policy, just because there's no kind of tariff that's imposed to any tech services or SaaS services, at least at the moment, in Australia. And another thing that we also need to kind of look at on top of the trade policy and on the tariff now is the Trump's latest move to abolish the IRS. Now, what that means is that obviously Trump is putting a lot of emphasis in abolishing the IRS and replacing the tax with tariffs. And if that happens, then what could also another see is that the inflation in the US could rocket high. And that will also question what the Fed might do in the next as well. So I think the first step is to identify whether any of your companies has that exposure to tariff and how much of their revenue is dependent on the US exposure as well. And another thing is we now have to really take action. I think this is now time to start actioning as to whether you want to completely avoid your portfolio from that kind of tariff risk, or whether you're happy to take that volatility and kind of trust what the management will be doing to offset that kind of risk. So it's a very difficult time, but at the same time, this is probably where it kind of really forces the investors to repopulate their portfolio.
All right, Jimmy, always a pleasure. Thanks so much, as always, for your time. Jimmy Jang there from Macro. Well, we talked there with Jimmy and earlier about what we saw with some of the big stock moves, and the stock of the day was one of the best performers, if not the best. It was Eagers Automotive, and Mark Gardner from MPC Markets and Anthony Golowenko from MLC Asset Management join Nadine on the call.
We see a network that has strong distribution, strong capability, and in an environment where perhaps there are some ongoing challenges and there are some margins to be recouped in and around that automotive industry. It's a positive result. It's something that's really a turnaround and perhaps a glass half full outlook of something that, you know, brighter days ahead for that business.
Overall, this is a good one to buy in the dip. Nick Politis, who's was chairman of the Roosters as well, used to be the old City Ford, and they obviously own the BYD licence. And
I didn't know that.
Yes, so
Okay.
and I think that's where a lot of the positivity is coming from the backlog. They've launched the new BYD Shark, which is the Hilux competitor. And Ford Ranger and Hilux have been, well, Ford Ranger only recently took over as Australia's top selling car, but the Hilux generally has been the highest selling car. It's sold out in 2 hours, basically, and they've got a massive backlog. It's a hybrid.
All right, let's have a look at some of the market leaders on a positive day for once. We just touched on Eagers there. Medibank Private as well. We spoke to the CEO. You can find that interview online. Neuron Pharmaceuticals, Challenger and Iris all looking good. To the downside today, we saw IDP Education. We've touched on the reasons why for that, along with Petrol. Zip, of course, as we see weakness in the overall tech sector. In the small end of town, we saw gains, I should say, from Clearview Wealth, up by more than 12%, and weakness in these stocks coming through on your screen, including Acro and MoneyMe, which was off by 9.5%. Tonight, pending home sales and US unemployment claims, along with preliminary quarterly GDP from the US and natural gas storage data potentially telling us about how cold people were in the Northern Hemisphere winter. All right, we are also looking tomorrow to the final day of reporting season. You can hear it in my voice. We're almost there. Life 360, Harvey Norman, and a number of other companies reporting, and we also get private sector credit coming through for January. All right, let's have a look at where the market is, up by 1/3% on the overall CBO 200. The ASX 200 has finished the session higher by almost 28 points, or 1/3% to 8,268. Final day of reporting season, final day of February tomorrow. We'll do it all again live from 9:45. See you then.